Welcome to this yield stripping panel. My name is Kamel. I'm going to moderate this session and I'm going to let our main people introduce themselves.
I guess you're looking at me. Hi guys, I'm Julian with Swivel Finance, and as you can tell, we're also working on a new project called Illuminate that is kind of in stealth-ish, but I'll likely be talking a little bit about today. And really, I mean, if you guys are here for yield stripping, you know a lot about the projects. We use an order book. That's our bottom line.
Hello, is this working? Yeah. So this is Federico. I'm working at Sense. I've been there for a year and a half already, and I'm one of the Solidity engineers. And yeah, have a background in computer science, and yeah, that's me.
Hi everyone, my name is Gaspard Peduzzi. And my mic is not working. Hi again. My name is Gaspard Peduzzi. I'm one of the co-founders of APY. I have a computer science background as well. Yeah, that's me.
Awesome. Maybe we can do an introduction about yield stripping and maybe explaining to our audience what it is about. Who wants to go?
We can take turns. Well, the way we describe it is that we take interest-bearing deposits. Usually these will be things like money markets, staking protocols, really those are the targets there. And then we allow users to separate these deposits into two components. Everyone has different names for these components, which is kind of obnoxious, I'm sure. But generally speaking, I think they're called yield tokens and principal tokens. And I think that's a good segue.
Yeah, well, more or less the same. I think that we will all be saying the same thing. So basically, we are taking any yield-bearing asset, let's say, for instance, CDAI, and we are decomposing these assets into the two components, the YTs and the PTs, and we are packaging them into these tokens that are maturing assets. So then you can trade against future yields, for example. So PTs will redeem one-to-one at maturity for their underlying, and then the YTs that have been accruing interest throughout the series until their maturity, then once they reach these maturity, they become worthless.
I mean, I don't necessarily have anything to add, like we're more or less doing the same thing. Definitely different similarities in the principal mechanism, in the yield token mechanism. Some protocol doing yield stripping are having yield tokens where you can redeem interest progressively. Some others are encapsulating the yield for a fixed duration, and you can redeem that at expiry as well. But I guess that's small differences as well, because eventually you can.
Yeah, I'm sure we'll talk more about them, but
Sure.
like there are a number of differences between our protocols that prevent a lot of easy one-to-one comparisons, let's say.
Absolutely.
Right? So I'm sure we'll get into them. As far as use cases, I mean, you separate off these two components, and then obviously the easiest use cases, then you can sell one of them. And this results in effectively fixed rate lending. The other side gets to speculate on yield.
Nice. And maybe we can touch a point on variable tokens. Like I'm hearing a lot, this is a really nice way to do some leverage. So maybe Gaspard, you can start on this and explain to us how this works.
So the variable part.
Yes, on leverage, like why it like really took off as a concept in the yield stripping space.
Well, as soon as you separate the yield from the principal, then indeed you can speculate on the variation of it. And like imagine that you are bullish and an interest rate that is rising. If you have different ways of approaching that way, the issue. You could actually deposit capital to generate that interest because you think it's actually more interesting because it will grow. And you can also buy the yield directly and taking effectively leverage exposure on it because you don't have to deposit the principal that is effectively generating that yield. So like that's definitely one approach. Depending on what type of leverage you want to have, you can also compound things in a different manners as well. I guess that's the initial first step for that.
So if I understand correctly, it's also a way to be really capital efficient, to be exposed on the variable part without putting the capital for the principal.
Yeah, and I think a great example is surrounding the ETH yields right now, right? So a little bit of self-shilling. We did just launch our Lido product, but specifically then there's been, with all of the FTX drama, a lot of volatility on chain over the past couple of weeks. And this has led to an effective doubling of the staking rate. So we saw it grow from about 5.25 to 10.75. And if you had been at any point in time before that massive growth purchasing yield tokens, your yield tokens would have effectively then doubled in value, right? So you as a speculator are not just then looking at this short-term, yield play, but the ability to actually actively trade yields with high amounts of leverage and to profit significantly from them, right? Like we did have users profit 100% over the past week.
Can we go through a concrete example on how people made money with yield stripping during like this period?
So specifically on our exchange, we had yield tokens priced at 0.01. So for every yield token you sold until March of this coming year, so about a third of a year, right? You'd be earning 0.1 ETH. That was with the rate at about 5%, right? And over the course of the week, as the rate massively ballooned, you saw equally the price of the yield tokens increase, right? Because these yield tokens are worth that proportional interest until March of next year. And then whoever had purchased them at the start of the week isn't just able to sell them as they appreciate before having to wait for all of these, the actual accrual to actually happen. So yeah, in that example, the user would have bought the yield token at 1 cent, sold it at 2, made 100% on their play.
So maybe to give a bit of context, so the yield token are the tokens accruing the interest rates from money markets such as Aave or Compound, right? So like when these rates go up, these token accrue in value. Is that correct?
Yeah, and I think the larger discussion comes around like how do you price the yield token and like what comprises of the value, and they both have design protocols that account for one major factor, time, right? The other factor, of course, is the rate itself, like I was just discussing there. But hop in real quick, talk a little bit about actually how you're supposed to price these yield tokens, I suppose.
Anyone wants to go on?
Yeah, and data? I don't know.
Yeah, again, again, it depends on exactly the mechanism of the yield token, because, for example, when we launched one other protocol called Kamel launched a yield token that was working quite differently, so eventually the value of the yield token was actually decreasing in value because it was effectively a token that allowed you to redeem the yield as it was generated until the expiry. So, of course, assuming a more or less continuous generation of yield, the closer you would get to the expiry, the less value that token will capture, so the less expensive the token would be. Indeed, there are different kind of factors. I guess if we talk about efficiency, because eventually, if you want about pricing model, it can be mostly theoretical, and connecting analysis and the actual market that we had, we saw what was mostly rightly priced, as we would expect, at least. Let's call it that way. And FYTs were quite volatile. One factor was the liquidity available, but also in a way, it's very hard to price dynamically those interest rates, knowing also that we were encapsulating a fixed amount, like a yield between 2 times 10. And so the user had to have the data on what is the yield that is already generated. Is that yield compounded? Like what is the yield that is actually generated on that underlying protocol? So we were recomputing all interest rate from the protocol that we were integrating in a permissioned way and displaying those interest rate on the interface. And a lot of time, maybe for all protocols, users were complaining, why are you displaying this APY? But I'm going to this actually the protocol website, and they're showing a different interest rate. The funny thing is, when you ask those protocol, how are you reading the API that you're displaying? Well, because you're lacking of the tool that is actually making you able to pricing that, making arbitrage a bit. Like the meaning of that API is different, because you can actually take action on it, and it becomes, there is actually an explicit market for it. And obviously everyone was computing interest rate in different manners. I guess having standards and dashboard like DeFi Llama computing those in a more or less transparent way is making that more efficient.
Uh, there's no standardization around how people are computing APR. So that's like the bottom line. And it's very frustrating, honestly. Our front end developer is very staunch about making sure everything is perfectly accurate. He's German. It's difficult because that means that we will be advertising lower rates than others, right? Specifically then, right, I always will remember Compound always calculated rates based on the block rather than actually based on time. And I think they've recently changed this, but this led to them actually underestimating the rates by about 13% for multiple years. Yeah, it's very frustrating is kind of the conclusion there.
Even better, one day an investor messaged me because he says like, why are you displaying a negative interest rate on that pool? Obviously the first reflex was to message the stat guy on the team and say like, please fix that, why is it not working? And then eventually connecting analytics on that pool, the interest rate was indeed negative, and it was a TrueFi pool, and then message the TrueFi team. And 1 week later, there was a postmortem about that pool that was actually had some kind of issue. So yeah, that types of data is definitely not available enough, and if it's not available enough, then it's making the pricing of those derivatives even more complex as well.
Yeah, good luck pricing them at this point in time. The data isn't quite there, but you can use heuristics, and the bottom line is that with liquidity, there will be people that are going to be, at least at this point, providing. I think a lot of it is toxic flow to some extent, and that's a larger conversation, especially with the stuff around Uniswap right now. But yeah, let's leave it at that, I suppose.
We touched like super interesting points. I can see some chat around standardization. We're going to talk about this in a few minutes. You were also talking about pricing, so maybe we can go in this direction and talk a bit more about what pricing mechanisms do you use? Like, for example, you mentioned that you have an order book, but maybe we can start with Fede and you can explain us a bit how do you price principal token and why tokens on the platform?
Yeah, so basically Sense has this custom AMM that we have built on top of Balancer, and that is implementing the yield space invariant, which takes into consideration the time, but we have adapted it so you could have a target instead of the underlying inside the pool, apart from the PTs. So you have actually two yield-bearing assets. One is the fixed income, the PT, and then the yield-bearing asset, the variable one, that is the YTs. So then we allow to trade them against each other, and not only, so that makes it more capital efficient, and it provides more attractive yields, and apart from the trading fees that you could have. So then this is like in general, yield stripping protocols are creating these yield curves that you can trade, that we compare against each other. So with these, and together with these space design that we have done, you can create more transparent and efficient pricing risks for it.
Nice.
So
yield space, just for a bit of background, is the formula or the pricing mechanism brought by the yield protocol on fixed rate, but that you have modified to use for your own needs. Cool. Anyone?
Is there any variation that you guys have implemented from the yield space model? I actually am unsure.
No, actually. So we're kind of between two versions at the moment. So it's I don't want to necessarily talk too much about the first one, because the second one actually changes a lot of the component, the exchange mechanism that we have, especially for the variable rates. But for the first version, at least, what we had is basically two pools. One pool where you have indeed a principal token against an underlying one, and then a principal token against an FYT as well. And the premises that we were making and variation of the price of both of the assets were mostly accounting a discount related to the yield that is left to be generated. Basically, the opportunity cost of having a locked asset into a fixed duration. So on the first pool, the PT underlying one, we do have some kind of weight shifting mechanism where we basically we derivate the APY that you're anticipating by the discount that is priced in the AMM, and then eventually we shift that, taking into account the yield that is actually generated. And on the second pool, because both of those assets represent a quantity of known or not known in the case of the FYT at the beginning of the period, both of those assets represent a quantity of underlying that will be unlocked at the same time. We do expect kind of the same discount mechanism. That's why we pair them together without any kind of weight shifting mechanism on that pair. That is completely changed in the new version, but yeah, that's all we do.
Cool. And just to conclude on our end, we're the only ones that haven't gone with a different variation of the yield space AMM. In that I'm very opinionated, and I believe that yield tokens should trade a lot like options do, or most derivatives. And generally speaking, at least DeFi has had a very, very poor past with options AMMs, just widely. In my opinion, it will be some time till we can really get an AMM that can provide liquidity in a way that is not suboptimal and or could not be done better on an order book. So our suggestion is, generally speaking, that users or market makers consistently come in, check the price on, or rather the rate on an underlying money market like Compound or wherever else, and then as well how much time is left, and actively adjust their quotes. This requires a lot more active maintenance and means we have other issues like integrations and like bootstrapping liquidity. But I think, obviously I'm biased, I'm the founder, it's probably the trade-offs that are needed to be made.
On which chain are you for the order book?
Sorry?
On which chain?
We're ETH mainnet right now. So the order book itself sits off-chain. So if anyone is familiar with the 0x model, or honestly it's quite popular, just EIP 712, everyone just signs orders off-chain, so that's completely free, and submits them to the chain. And in this way, if you're a market maker, you can just sign orders that maybe only last for 5 minutes or so, and actually pay nothing for providing liquidity, right? So you can be kind of an active liquidity provider without actually having to pay for it.
Just to jump on that, I actually agree with a part of what you're saying, definitely. In terms of efficiency, market making, and the automated market makers, I think eventually if we want to have something very efficient, you need active management of orders and that kind of thing, and that's not necessarily something that is done in an AMM. That being said, we actually, when we launched the first beta version, because we were still working in the AMM, we actually launched an order book with 0x as well. And I guess the issue there was trade size and fees related to that one. But yeah, that being said, I think there is you can kind of mix the two components as well. But for variable weights, they behave in a way where I don't think there is currently an AMM design that fits them efficiently.
Yeah, I don't think, we've seen again with options that honestly, people have started to move away with even trying to completely provide liquidity for options in any one given way, right? There's newer protocols like Primitive and Panoptic that just replicate options because they figure you can provide liquidity for that easier. I don't know exactly what the solution might be overall for all yield stripping. On Swivel's end, this is where Illuminate immediately came in, which is like, we couldn't necessarily get easy integrations because we use an order book off-chain that is difficult. As well, it's difficult to get integrations, I'm sure, for everybody based on the amount of liquidity available within the space. So, in my mind, we needed to provide an easier interface for ourselves. Of course, that's biased, but then as well, everybody else.
Yeah, maybe this is a topic that we can now talk about. I will start by an example. I guess most people in the room are familiar with Yield Protocol and Notional Finance. Something really interesting that Yield Protocol did this year, they started to accept the tokens from Notional as collateral to allow cross arbitrage in the protocols, and that brought some significant volume to the protocols. Standardization in the fixed rate space is an issue, especially to recognize the tokens between protocols. And I guess we're going to talk about Illuminate at some point. But maybe, Fede, you can start and tell us more about what kind of efforts Sense Finance is doing to recognize their own tokens or on other platform, or maybe start accepting other tokens as collateral in Sense Finance.
Yeah, so I think that that's a bit one of the characteristics of any yield stripping protocol, that we create these two tokens, the PTs and the YTs, separately. So having this gives them interoperability, because you can decide what you want to do with those tokens separately, right? For instance, Sense Finance has just announced an integration, like a partnership with Fiat DAO, in which you can use the PTs as collateral to mint fiat to then do whatever you want. For instance, one of the use cases would be that you can buy more PTs, more Sense PTs, to do some kind of leverage, right? But I think this is even a particular thing from yield stripping protocols, and not only from Sense. And this is why yield stripping protocols are great. The flexibility, the interoperability they offer, right?
I'll talk a little shit, honestly. Working on Illuminate, I mean, I had to integrate all of you guys. All right, so I integrated 8 protocols or so, and the lack of standardization is pretty horrible. We had protocols that had no test nets available. We had protocols that were ahead of development on live. Essentially, we couldn't figure out what their actual code base were, and then at the end of the day, everyone is from the basic core mechanics. There are some differences between many of the protocols. Principal tokens, luckily, are one thing that seemed to be relatively ubiquitous. So that's something that I think maybe you're not in the group yet, but I know some sense people are. We're working on a standard for principal tokens. I believe it's EIP 5095. You're nodding your head if you want to get some words in. Yeah, did you have any comments, I suppose? Are you guys implementing? I think I saw that in your announcement.
Yeah. So it's definitely honestly, I think it's a very great initiative indeed. We're lacking of standard for that kind of thing. The reason why we did not do standard at the beginning is because we were kind of the first to build both of those primitives, and we needed more insights on how to design efficiently this thing before being able to do any kind of standard. And really appreciate that initiative. And definitely, I want to mention, you reached out to all the project and all that.
It's not final yet, so get.
Yeah, I know. But
yeah, please.
And we'll fall back and actually maybe the different element of that proposal for now. But yeah, those standards are very needed. I think when we just talked about pricing models and eventually how and market component like an AMM or an order book to have efficiency or to have liquidity. I think what is restraining liquidity is also a lot of different constraints that we have in our product that eventually we can shift in maybe modifying maybe the primitive design and elements that we had initially, mainly like PTs and YT. Maybe there is still some things that shifting a little bit would help gathering liquidity, whether it is on an AMM or on an order book, that's more related to pricing and dynamics. But consolidating liquidity, and I'm not speaking about the Uniswap V3 type of way, but pooling liquidity in a different way would also be very efficient. Of course, you need standards if you want to work on all those things. I think Fiat DAO was a great example because they reached out to all those projects and they needed to build adapters for all those projects. And to be fair, we were kind of in the same situation, right? Because before for 626, we had to build adapters for all the protocol that we were integrating as well. So
have you guys integrated 4626?
In the second version, yeah.
Okay,
and it's completely compatible with the V1 as well.
Yeah, we just launched ours on Thursday.
Correct.
Can we put a bit of context? Can you maybe explain to the audience what Illuminate is?
Sure. So Illuminate is a principal token aggregator, right? So all of these protocols that we've mentioned have this core mechanic, a principal token, including protocols like Yield Protocol and Notional, right? So they can be included in the same bucket. And really, at the end of the day, if you're a lender, all you do is purchase this principal token and capture the discount as it accrues. So it's very easy then to aggregate this by essentially just providing users the one with the cheapest principal token and just allowing them to lend against that. Then really we go a step further and create what is known as we're calling it for now, at least a meta principal token, which allows any of these principal tokens to be wrapped into this one meta. And from there, any protocol can effectively access the best yield at any given point in time across all of these protocols, at the same time as also getting what is effectively the combined depth of all the protocols as well. So as we've been talking about, there are many issues to really integrating not just Swivel. We have issues off the bat because we're an order book, but everyone for more structural things. And really, that's like the thing we're trying to solve for Illuminate is allow people to actually build on top of fixed rates.
Nice. So I think like there are two protocols working a bit on integrating different P tokens. So Illuminate is one of them, and the other one is like Fiat DAO.
There's more. There's a lot. I think something that hasn't been announced public much yet, outside of like an AMA we had with them, is the index coup integration of principal tokens. In that index coup with their upcoming stablecoin product are actually going to be likely the largest rate trader in the world, at least in DeFi. Right now, I think I am, which isn't to say much. This means it's small. But with Index Coup's new index, they will effectively be purchasing the cheapest principal token and selling the more expensive ones they have within their index. And what this effectively then ends up becoming is a mechanism that helps equalize rates and create an equal trading ground between all of the environments, and as well just deepens liquidity for everybody. So I'm pretty hyped about that one, at least.
Nice. Indeed, it will be way nicer to see like interest rates being a bit more homogenized across like protocols.
It should be dynamic. There should be like an ecosystem, and it should be easy for arbitrageurs to trade one yield token for another one, or like to understand these mechanics. And I think it starts with them.
I'm very conscious about time. I would like to take the last few minutes to take any question from the audience to any of our panelists.
Hi. So yield stripping is quite a technical concept. So how do you make yield tokens more of a retail-friendly type product?
Sure. Well, we redesigned them into building something that is more of a product where you can take directly actions that relates to your need and less to the technical component of it. When people came to AP1, they spent a really long amount of time before understanding how that works. And then when they understood how that works, then the question was, they were like, oh yeah, you can do so many things. But you had so many constraints that eventually, if you wanted to do a fixed rate borrowing, if you wanted to hedge your risk on different things, what we actually tells, like that's the main functionality of the product, but it was too complicated. We were explaining AP1 starting from the protocol because we were engineers, we built it that way, and we know how can we use it, but the user can't. So we changed completely the UX, we changed the design of the variable rates and many things. And so now, and it's not public yet, it's announced and in details, but we built something that we think is an actual yield market and not just a decentralized exchange of a tokenized deal with many duration for different types of assets with different kind of standards. And I actually have a question related to aggregation of principal tokens. How do you necessarily tackle expiration and that kind of thing as well? Yeah, so having a more product-driven approach for that kind of market is really necessary, because otherwise you're just building the primitive and then you need people to build a product on top of you. But if you want people to build a product on top of you, then you need standards, you need efficiency and that kind of thing.
Maybe we can take a last question, if any.
I was curious to have your opinion on what is going to be the next, thing that's going to trigger growth in the fixed yield and yield stripping and space, because so far, like protocols like Notional or Yield have struggled those last years out to find a deep product market fit, and maybe there are like deep reasons for that in the DeFi space. Maybe that we're missing real world assets. Maybe I don't know. And curious to have your opinion on what is going to trigger the next growth era on that specific field.
It's an easy question. Absolutely not open-ended.
Same answer. Yeah, Contango. There will be protocols integrating fixed yields at the least, right? This is a question that is most asked by investors, so there's easy answers there, which is, of course, there will be growth from banks, blah, blah, blah. It's easy to onboard the staked ETH market more than any, so that is actually extremely important. But then, you know, there's so many things that can actually be built with fixed rates. And one thing that people don't realize is that there is actually a structural advantage for DeFi for fixed rates that doesn't exist traditionally, and that you can create products that are atomically maturing together. Right? Like there's no settlement time, there's no issues there. So you can create things that completely mature, like futures, expirable futures that mature at the same time. And what this ends up becoming is, or rather turning fixed rates into, is effectively middleware, right? Of course, you can try to attract your own users, and owning the user is something you should do. But realistically, what you can guarantee the growth will come from is futures, is options, is index, is stuff like fiat DAO.
Yeah, just to finish with this, I think it's important to let the different players know like how the yield stripping protocols allow you to customize the yield exposure you want to get. So understanding that will bring more volume and more growth, because we, the ones that we are creating and building these kind of protocols, are giving them, not only the users, but the DeFi yield generating protocols, the ability to choose or curate how much risk they want to have. And that's, I think it's important. Once that is understood, will bring more volume, definitely.
Are you good with the answer?
Yeah, I think it's maybe Gaspard or Contogo, if you want to, like, Kamel, if you want to add something, or I did like I'm sure you agree with the.
Yeah, I must agree. Obviously, like Contango is an expirable futures protocol built on top of fixed rate markets. So obviously, we want to bring volume there by bringing like use cases that are used a lot in TradFi or CFI. I will have the chance to talk more about it this afternoon. I think we're over time, so I would like to thank you for attending this panel, and also thank you for participating.
Thanks for coming.
Yes, I wish you enjoyed the talk.
Thank you.
Cheers.